Hey guys, this is JR coming back to TopBrokers360 to share my weekly economic outlook. Now, as usual, please remember to visit the site. It will definitely help boost that on Google and of course watching this video on YouTube. So make sure you like and do subscribe if we have that availability right away. If not, we'll soon have the channel, but I want to make sure that you guys come back every week to get the best content that is available and the levels that you need so you can actually have a better positioning into your investing month or your trading week. All right, let's begin. So lots of things happening, and one of the things I like to go over is everyone is now calling for tops, right? Everyone is calling for tops, and I'm here to share with you one perspective, nor it's that I don't think they make some sense or that it's not gonna happen, right? It's not about that. It's not just understanding that the market has the potential to continue, but why the market can continue. Right now, in front of you, for educational purposes only, I have on the left, I have the S&P 500, applying it to SPY, which is the ETF, Exchange Traded Fund. And then to the right, I have NASDAQ 100, that will be with the QQQ, the Qs. Now, if you pay attention to the bottom panels, you will see that I have the overheated RSI, which is mean pretty much relative strength index. But if you pay attention to the S&P 500, one of the highest reading was 80. Okay, so why is this important? That's important because we are so far 64. So the market may have a little bit of a pullback as we did on April and then continue higher. So look out for pullbacks. But the reality is we don't have any evidence based on historical RSI to say, oh, the market is topping. It's not really, not yet. Now, of course, if you think about other points in time, like May 2014, that pullback all the way to November of 2015 was just a continuation of the secular bull market. The same can be said for American technology. American tech has been doing pretty good. There's some perspectives like Tom Lee's from Fundstrat in New York, that he does make sense, understanding that these companies, they are catered to work and be very durable opportunity for investors that have that are looking for quality, are looking for liquidity names, very liquid names. That's what American tech is offering you. So if you look out up here, I think it's right there, look at the RSI. The same story. We are at 70 versus potentially levels that at that point in time, one will say, oh, well, I think in November of 2014, this is the top. We're going to have a massive crash. We didn't. We have a pullback, strong correction potentially, and that just meant a buy opportunity into January of 2018. And then, of course, you have one more pullback in December of 2018, and then went all the way for a recession that you can see that recession is somewhere here in that deep. That was considered a recession. The RSI is resetted and then continue higher, and then we have a very strong bull market or recovery from the bull market in just about a year and a half. So point of the story is, as far as understanding levels, we don't have evidence yet that we have we are in the final top. That does not it doesn't mean that it's not building up. Just pay attention to that. Now, of course, what are the things that we have been noticing this week that make sense for investors and traders? Well, of course, it doesn't need presentation. Tesla is doing very good. And by the same hand, I want to show you exactly why I think there's more opportunities to the upside. Always paying attention, if you're an investor, to opportunities to load, once again, shares based on your risk profile. So I will start talking with what is obvious. A little bit obvious is just understanding that the 200, it's a very key level. Why? It's pretty much because stocks, they love the round figure. That's what it is. They love the round figure. So you want to pay attention to this because, yeah, I might want to be a buyer if we get here. What will be a view that will say, okay, we're breaking down, this is not going to work, it will need more time to rebuild the bottom? Well, if we actually break under that 137, which is so far the low of the year. So I'm going to switch that to red. So give us a sense of, where's the red? Yeah, here. Give us a sense of urgency and to understand that our positioning might not be working because of that breakdown. Now, of course, always remember this low is higher than the previous low back at the beginning of January of 2023. So we have, in fact, we have a trend, or we can say that we have some evidence that we have a bullish trend developing. Now, a lot of the chatter in Twitter, well, X now, is basically the 3-year bearish trend line. It's broken. This is not a This is not a gimmick. This is happening, so you want to pay attention to that. And why is this development very important for you when you look at Tesla? It is key for you because now there's a lot of energy. Now you have companies, of course, like NVIDIA that are pausing, potentially Broadcom, names that they do matter in the tech space as semiconductors. But then you have the we'll call laggers of 2024, Tesla and Apple. Apple already back on the green year to date, and now Tesla, it's kind of getting there. So the point of the story is look for the upside. At the upside, you're looking for this level. That will be in yellow for me. That will be a key level, the 300 level. Now, before that, of course, you have other levels. You can actually think about what happens around 270. So I'm going to change that to a little bit of green. So those are the levels. To always have perspective, the bottom, and also the upside potential. In that sense, I want you to pay attention. Look at the bottom panel. What do you see? Slightly moving up above 50, which means this is nowhere in any euphoria. There's a lot of room to go up, but always remember to consider that although assets will move up, you have to pay attention for your downside. And depending on your risk profile, you want to make sure to understand that this level is the key level in 2024 for Tesla. Continue. We have a kind of narrative of what's happening as well with these names like Apple. So Apple is going up and nobody cares. So what do you have? You have a breakout of a top. Let me just zoom this out. And RSI is nowhere to be overbought, okay? So right now, the fact is that it's at 66. It's telling me that we are not too far from the 80. Now, that takes time, of course. That's back on August 2020. But before that, you kind of have you may have a few pullbacks on RSI that will reset the price and allow you to look for an entry. The reality is that we are at this key level when it comes to Apple that will be feeding the potential continuation of the stock market because, as they explain, technology has a relevant, I think it's a 30% of the indexes. And believe it or not, like it or not, that's just the way it works. Concentration for them is a feature, not a bug. So the bug is telling you, oh, we should have more small caps companies doing well. But the reality is that there's some number close to 40% of those companies that they don't make money. So you want to pay attention. Where are you sort of like adding your part of your savings, or where you're allocating capital? Look for strength, especially in 2024. So right now we have this breakout of the double top of July and December. And all it is, think about this, is just this move, right? You can say that this is pretty much this, and then you have the breakout, and there you go. All right? So what to expect? If I were to say to the upside, we'll continue up another $72, past the breakout. Once you pass that level, you're looking for a move to 276 potentially. Previously, that move from that bottom to this high, that's 57%. Don't expect that to be the same. There will be a little bit less. But when it comes to the dollar value of the push higher, pretty much will be sort of the same. So still a little bit of room. I will be cautious if we break my cautious level. I will be cautious to the downside if I break 165. So let me change that to red, okay? So the bottom line is that we have seen this week stocks that were not participating, joining, and telling you that there's a lot of strength, a lot of side businesses that are working for these companies, and there is a rotation, but not just a rotation in capital, but also a rotation in sentiment. Tesla, for example, had 2 years of very bad sentiment against Elon, all the chatter on Twitter, and then of course you have Apple, all the discussion, the negative sentiment based on the Chinese market, which is key for them, of course. It's key for any company, as well as other companies see the United States as a key market for their products and services. So something to pay attention. Now, of course, as we move forward to potential catalysts and what to expect for next week, please remember to visit TopBrokers360. Make sure you visit, make sure you tune for next week. I will bring more of this analysis and a few ideas that I want you to consider and pay attention as we enter we're just beginning the month of July, and as we enter a new trading week. The real catalyst that we have to wait for this week will be non-farm payrolls and the unemployment rate. There's a little bit of the fight, and there's a lot of haters going into the no landing, nothing's going to happen, or terrible landing, and of course you still have the soft landing. Now, It's very difficult to find a common ground with social media influencers, stock market commentators about the potential for a soft landing. But the soft landing already happened. It already happened. It's not perfect. Now, of course, the sentiment is more inclined to the fact that services and products are higher, and it has to do a lot with the aggregated inflation. That's the real challenge. Aggregated inflation, which right now in the United States from 2020 is 25%. Got to be somewhere around 20, 25, maybe 26. Which means is the fact, for example, you go to McDonald's and a McDonald's menu, it's way higher than it used to be 5 years ago or 10 years ago. That is not just because they want to, it's because over time, services and products will increase their price until there is a disruptive product or service that might offer more efficiency, and therefore, because that increased efficiency, it will be sort of cheaper. But eventually, also, they will look to be selling premium stuff. The bottom line of the story, look out for tomorrow to be the main catalyst in how the end of the month of July, especially next week, will decide to be if it's going to be very bullish or it will be flat or even consider a little bit of a breakdown. What I'm looking is to understand, and everyone is to pay attention to the figure. Prior, we got us 272,000 jobs created. What the market is expecting is 190. Make sure to consider this. If we print a figure below, the market will read bad news as good news for stocks, but it's not. It's just a process that it participates on how to build the top. When bad news, not a lot of people are working or not a lot of jobs were created, then of course the market will think that that will boost the confidence, and the Federal Reserve will say, okay, we need to do something. There's finally some evident cracks that is not just our imagination. This is what is happening in the market and we have to take action. And then the rate cuts, they will pop, and it can be 2, probably 3, but just count on 2. That might be the case. But if that figure is above 272 or is at 272, it will still imply a very strong labor market. And although already Jerome Powell determined that, yeah, we are already back into the disinflationary, disinflationary path, might not be enough, and they're very cautious. But in reality, some numbers indicate that they actually need to cut. They're in a good position to cut because the monetary policy in America is already restrictive, where inflation is and where the interest rates have been for probably more than 6 months. So this is very restrictive, and they are working. As we all know, the expectation is to understand, we need to understand that they're working with some laggard indicators. Guys, thank you so much. This is it for today. Remember to tune back next week for more of the weekly economic outlook.